It seems that things work.
Okay, good afternoon.
Madrid. I'm here in. I've been teaching an MBA course on an Aalto ESADE joint MBA program, and I'm here at ESADE's media office. So that's why I have this fancy background and have pretty fancy technology here. People have been helping me kind of to set this thing kind of up, and it looks that it works. So good afternoon, everybody. So today's topic is fundamentals of financial institutions and especially commercial banking. We'll talk about how banks' balance sheets are being evaluated and how that is somewhat different from, say, non-banks, say, for example, for industrial companies. That is something that Mikko from Aktia quickly mentioned, how they have so little equity in their balance sheet relative to, say, many other companies. So that is the market practice in banking. And that is simply because banks' equity ratios are calculated differently than any other companies. Let's start with a Financial Times article from 2019. As we have been discussing past Thursday, we discussed about what has happened in European banking regulation, the stress tests, first round, second round, third round, fourth round, and it looks that, and it's obvious that banks' balance sheet have been strengthened quite a lot in Europe, but still now it looks that according to new regulation, so that is Basel IV, the European Banking Authority said that it looks that the largest banks in Europe, if this Basel number 4 will be applied, so there will be another 135 billion shortage in a capital. So it looks that still things are not as good as they should be according to the regulator. Banks are complaining about this, and that is the status currently. Some banks are kind of hit worse than some others. There is something that this article refers to is Basel regulation. That is something that I will explain you today, and something called internal risk models. So what are these internal risk models? What are they about? It has to do with kind of how banks are allowed to define or measure their risk in a different way, totally different way than what is the status in non-banks. Okay. Everything works kind of way. Let's do this way. There we go. I'll just make sure that I can see it. I cannot see the screen, or is it just me? I can see it. So can you all see it? Now the slide that I have here that you should be able to see is the lecture overview. Can you see this slide? I can see Camilla is saying that. Juho, Matti, good. So today's topics are, first, let's take a look at banks' balance sheets, banks' performance, regulatory capital, which is the key here, and another is the calculating risk-weighted assets, and then these internal risk weightings that IRBA models that banks are allowed to use. Questions at the end of the lecture. Let's return to these once we are done. How are the bank's capital ratios calculated? Why is this different than in industrial companies? What is the Basel regulation? And then the key question is that why bank balance sheets and performance and risk are so hard to evaluate. So why it's not a rocket science, but it seems that just as a sign that we have needed these several rounds of stress tests and new regulation and Basel regulation, and still it looks that kind of that there is work to be done for the regulator and other stakeholders to find out how really banks are doing in Europe. So to start with, bank's balance sheet consists of liabilities and equity like any other companies. Banks finance the operations typically with deposits, core deposits. Low interest rate, as we know currently in European countries, is typically generally zero. And they also finance the operations with something called managed liabilities. They can borrow from the money market. They issue bonds. They issue several different, say, hybrid instruments, even more than industrial companies. Has to do with this, how the capital ratios are measured, and that is something that I'll explain in a minute. Equity is like any equity. Equity value for the book value is the assets minus liabilities. We'll see that is a pretty small proportion of the total assets. The end of the balance sheet value. Regulatory capital is what we'll explain in a minute. And the market value of equity, this is the same as any other company, is the market value of assets minus market value of liabilities. Like in any company, equity capital serves as a cushion against losses from bank's operations, and that is what we on Thursday we started by noting that in financial crisis, the taxpayers recognize that we can't continue like this, so that companies only have say 2% equity in the balance sheet. So that is the cushion against losses. So it has been too low. Generally, banks have low equity ratios, or in banking terminology, they are called leverage ratios. How they use the funds is they make loans, as we have seen. They issue housing loans, mortgage loans. They issue corporate loans. They use different kinds of even consumer loans, and they make some investment activities as well. Less so nowadays as they were doing in the past. That is something that we will discuss when regulation is being discussed. This is the tightening, especially the US market, that was decided that banks are no longer let to trade on their own books. So taking risk with their balance sheet that much as they did before the great financial crisis. This is the old school, say, the traditional banking business is that banks borrow money and they lend money to the clients. Something that Mikko from Aktia mentioned, he mentioned the capital light asset management business. So that is the fee generating assets. Those are the fee generating assets. So banks have been, especially Nordic banks, have been actively building the asset management business, the mutual fund business, for example, which is the key difference here. The key difference here, why this is capital light, is that mutual funds assets are owned by the investors, not by the bank. So this is the key difference. So bank borrows money, that money, those deposits are on the bank's balance sheet, and the bank then lends them forward. So all those deposits and these loans, they are in the bank's balance sheet. But when Nordea, a mutual fund company, they manage Nordea's mutual funds. So those funds assets are not in the books, in the balance sheet of Nordea. So Nordea runs the business and it generates fees. So they collect fees, asset management fee from that activity. And if there is a loss in the value of the fund, so that does not lead to any losses in Nordea's balance sheet. But customers, they benefit if the mutual fund value goes up, and they lose when the value of the mutual fund goes down. So they take the risk. That's why from the regulator's point of view, and that is from the taxpayer's point of view, there is no need to require a lot of capital from asset management business, from mutual fund business, for example, because risks are being taken by the end investor, not the bank directly. And that's why when the regulation has become tighter and tighter, and there have been in this zero interest environment, the profitability of this old, say old-fashioned or old traditional banking business, there has been pressure for profitability. So banks have been very interested in building. Nordea has been massively building the European-wide asset management business, for example, because it's a fee and generating business, and it's capital light, kind of not that much equity is required. Non-earning assets are just the buildings and whatever computers, systems that the banks have. They are not non-earning, that just make some proportion of the assets of banks. Any questions, comments? You can put it on chat or you can ask. Or shall we go forward? Okay, just as an example, this is from, as I originally promised, we will come back to the Aktia's numbers. Mikko didn't use that much time to go through it. These are directly readable from the material he sent. Example of lending and deposits. Aktia is a bank, and they, from the share of operating income, banking business in the first 9 months last year, 48% came from the banking business, and asset management made 39%. This asset management share has been increasing. That is the income. And then in terms of the profit, so banking business 33 and asset management 51. And asset management, as we heard from Mikko, asset management is the way to go. This is that they see the greatest the growth potential, and as one side of that they see that they can grow on this area. It was the acquisition of Taaleri's asset management last year's spring. The balance sheet. The balance sheet in terms of assets, if you look at the September 2021, it's lending to public and public sector entities. So that includes households, and that is housing loans and other loans made for public and for public sector entities. That is the biggest proportion of the lending. They have some life insurance assets, including unit link. This is something that Mikko mentioned. We'll come back to the unit link. What is that of a product? That is an investment link kind of insurance savings. That is, we'll come back when we'll discuss about insurance companies. There are some other assets, such as the buildings that they operate and systems that they own. Liabilities, how they finance the operations. 4.6 billion as deposits from the public, so that is biggest proportion. Liabilities to central banks, 795 million. Debt issue, securities issued, 3.1 billion. So though mostly it finances its operations through deposits and debt issued to investors. How bank performance is being measured. Bank stakeholders are interested in bank performance, kind of as self-evident. It's not only for the regulator, but shareholders, employees, customers. These ratios are supposed to indicate how healthy is the balance sheet, how strong the bank is, and how profitable it is. Bank-specific performance measures are such as cost-to-income ratio, return on assets, return on equity is just like for any other company, and then bank-specific capital adequacy ratios are something called Common Tier 1 capital ratio, Tier 1 ratio, capital adequacy ratio. So these are bank-specific figures. Meaningful comparisons, like for any other companies, trend time series analysis. Banks typically are compared with other banks. As Mikko was suggesting, that kind of Aktia, they find it difficult for them how they should be compared to, whether they should be compared to Evli or whether they should compare to Nordea. They are a bit different animals, so they find it a bit difficult kind of what is the best possible kind of a peer group for them. So it leaves that for investors to make the decision. Of course, control variables include bank size, location, type of business. Is it retail oriented? Is it asset management oriented? Is it kind of old-fashioned borrowing and lending oriented, and so on. This is something just to keep in mind when comparing ratios of two different banks. Cost to income ratio, the first bank-specific measure, shows the company's costs relation to its income. To get the ratio, you divide the operating costs. You have administrative costs, fixed costs, salaries, property, and so on, by operating income. And this is the key measure in terms of the efficiency of a bank. The lower it is, the more profitable the bank. This is a snapshot from Europe's 50 largest banks by assets. And at the end of Q2, at the end of June last year, we can see that there are ratios from Sberbank of Russia, 31, seems to be pretty efficiently run, all the way to Commerzbank, 107%. So there's a huge variation among the largest banks. What makes this interesting is that is the variation itself. Plus, if you look at Commerzbank, it's a German bank, Credit Suisse is a Swiss bank, Norddeutsche Landesbank is a German bank, Deutsche Bank is a German bank. Then we have this Monte dei Paschi di Siena, the oldest bank in the world, Italian bank. So it's looked at German and Swiss banks are pretty inefficient. Well, it's just an observation. Now let me see, there's a question. Samsa, let me kind of, let's come back on this issue. I didn't see this news coming last Thursday. The bond was priced with negative marginal compared to swap rates. This is a good question. May I ask you to send, could you please send this to me by email so I can take a closer look at this? What is what this is about? Sure. So good. So please. So I didn't kind of point this out. There are currently kind of a we'll discuss this about. Yeah, this is something that I was preparing the Thursday's lecture. So it becomes pretty complex as so what is complex? It's kind of the regulator has let's say one example. It most probably does not have to do with this, but such as kind of the central bank, that has to do with your the term paper, the green investments, the green policy of central banks. So central banks, if you, the ones who read Helsingin Sanomat, that was in last week's Friday, there was an excellent story in Helsingin Sanomat about UPM, so that is a customer of Nordea. So UPM borrowing from Nordea, and that money was earmarked to a green investment in terms of biodiversity. And so what was the point in the story was that there were very interesting kind of dimensions. One was that, as the story highlighted, was that how to measure biodiversity. Nordea is a pretty new thing to everybody, even Nordea. UPM has developed its own metrics to measure biodiversity, and so it's a very new kind of seems to be a growing area in UPM's business. And why that was relevant from Nordea's point of view was that central bank, which obviously Nordea is being supervised by the European Central Bank. European Central Bank has not only with its own investments, which they as we will see in the term paper, they see that their role in this in the fight against climate change is so important that they need to do something with their own investments, but also in the banks that they supervise, they accept lower margins or require less capital for the loans that the banks make with our label green or biodiversity or whatever, which is a totally new thing. Kind of the biodiversity is kind of a very new. UPM is one of the first ones, kind of as one can read. So there are specific. This Aktia specific case. I will take a closer look. Thanks, Samsa. But European Central Bank makes specific kind of deviations from the basic rule that they considering certain kind of certain, such as the greenness or whatever. Seniority is one thing, that seniority of the bond. So they allow different deviations from the basic regulation. So we'll talk about this on Thursday. But the Aktia's case, kind of, I will take a closer look. Thanks for that. So coming back to the bank's performance. So yeah, German Swiss banks are pretty inefficient. Aktia, the Mikko mentioned that Aktia has publicly announced that they have financial targets for 2025. Comparable operating profit 120, something that some of you were kind of asking that how feasible, how viable of a strategy that is. Kind of can we easily kind of achieve that? They made 66.7 in the first 9 months, so you might say, okay, as long as they are able to grow their business, especially asset management, so it should be kind of achievable in 3 years' time, or is it 4 years' time then? And comparable return on equity, the target is above 12. In the first 9 months was 10.4. Their target for cost-to-income ratio is to push it under 0.6. In the first 9 months, it was 0.64. So this is a clear metric that we can see that Aktia follows themselves, and they set public target, and this is something that they try to push down. So that is to run their operations more efficiently. Common equity tier 1 capital ratio, the target is to have that above 1.5% percentage points above the regulatory requirement. In September, it was 2.7%, 7 percentage points over the minimum capital requirements, which was 7.7. That's for Aktia. And this is what we'll discuss next. What is common equity tier 1 capital ratio? So cost-to-income ratio 0.64. So on this European kind of comparison, if you compare Aktia with the big banks, so it's somewhere there you could say, in the middle or so. Nordea's cost-to-income ratio is less than 0.6 already now. So that is banking business typically is described as an economies of scale business. So large companies are typically more efficient, but that does not apply to, say, Deutsche Bank, which is one of the largest banks in the world. So they seem to have difficulties in pushing this cost base down. Then the question is that Aktia's operating profit, where that comes from? It comes from net interest income, net commission income, and from life insurance. That's the source of operating income, as we already saw. The profit comes from the banking business, asset management business, more so nowadays in the asset management business. When they're trying to push, this is not something that Mikko mentioned actually at all, as in their, you could say, never-ending kind of a journey to make things more efficient. How can you make savings? So what are the expenses of a bank? So this is from Aktia's interim report. Staff costs make more than half of the costs. So it's essentially salaries plus IT expenses. So these ones you need to push, kind of get lower if you want to have your cost to income ratio getting better. And this is an area where Aktia, like many other banks, have been doing operations for long. And this is like just took from 2017, so that is 4.5 years ago. That was before Mikko joined Aktia as a CEO. So they have renewed their model of operations. So I have highlighted here that 10 branches will be merged. So they have been closing down or kind of closing down branches by merging them, and what they suggested was that the demand for individual services is increasing, and the need for traditional banking services is decreasing. So that is a trend that you have been observing in the banking area for many years. That it used to be that there was a bank branch in all kind of even small villages everywhere throughout the country. The branches, such as in Espoo, Lahti, Tenola, Broomar, whoever has been in Broomar, where I happen to have a summer cottage, it's a place where there are 400 people living. So that was essentially closed and merged with the one in Tammisaari. So these cost base, which has originates from running too many branches, all of them with their own kind of employees. So it has been to scale down, as partially that has been possible as how do we do banking kind of as household representatives, normal people, individuals. So we hardly ever nowadays, we don't need, there is no need to visit the bank branch in person. So we do our transactions by online. So whatever bank activities are needed, so we need to do. So if you think of yourself, when was the last time you visited a bank branch? So it could be a year, it could be 2 years. It could be that when you buy a home, when you buy a house, you take a mortgage loan, you go physically in the bank branch, but most of these activities, banks have been, especially Nordic banks, have been able to develop their offering, online offering, so that there is no need for customers to go in person to visit a bank's office, which has been, it has allowed banks to close branches. 2019, when Mikko already was the CEO, another round of cooperation negotiations, meaning that they were, as the title says, has decided on changes leading to reduction of 92 jobs, and approximately 50 employees will be offered a new job. So they are scaling down employee costs, so salary costs. We are now creating a bank that is ready for both current and future requirements. The continuously developing technology, as we see, and changes in customer habits lead also to a change in customer behavior. So this is what we have been seeing. It has been going on for years and years, and that allows banks to close further branches. Now with Hoskär, Nagu, Korpo, Hanko, Ekenäs, if you just think of these, they're pretty small places, Swedish speaking mostly, so they will be merged to another branch. So these are all, as I said, never-ending story of banks kind of acting to scale their cost base down. At the same, obviously, kind of IT costs don't go down, but economies of scale, IT costs kind of don't scale. They scale pretty much kind of at IT offering. Once you have the well-operating IT system, you can take new customers with pretty marginal additional cost. The planned measures are estimated to lead to annual savings of approximately 3 million starting from 2020. And another kind of highlight there on the bottom is Aktia is strongly developing asset management services. So especially asset management service, if one business is economies of scale, so that is asset management services. And that is what Mikko was confirming as his visit, that this is the business that they're trying to grow. Okay, then we come to the regulatory capital issue. The measure of banks' common equity capital as a percentage of something called risk-weighted assets. So this comes from something called Fourth Capital Requirement Directive, CRD. It came into effect on 2014. And what this is about? Banks, let's not go into details of how Tier 1 capital, Tier 2 capital, core Tier 1 capital, what they are. For the sake of simplicity, it's enough for us to remember that Tier 1 capital, which is more or less kind of core Tier 1 capital, is shareholders' equity and retained earnings. Let's keep it as that. It's shareholder equity and retained earnings. Capital, say Tier 2 capital, includes different reserves. Banks issue many different types of hybrid capital, subordinated term debt, different versions of debt with different seniority. There's a question on the slide 10, the cost-to-income ratios of European banks. Could you please explain why is the spread so high between different banks? That is a very good question. I can't answer that directly in one very short answer. One big explanatory factor there is that unlike in Nordic banks, so many, especially Southern European banks and German banks, Commerzbank, Deutsche Bank, they have their non-performing loans have been pretty high. So they have made losses, credit losses. They have made customers have not been able to pay their loans back. And if you just think of how big of an influence that has to cost-to-income ratio, if the income is just as a result of one, say, big customer kind of defaulting or making bankruptcy, so that is just a massive influence. While Nordic banks is essentially the non-performing loans have been minor or kind of not a rounding error, but very close. But the credit losses of Nordic banks have been very small. So that is a major effect on cost to income ratio. The second thing is, if you just look at the Italian banks, Monte dei Paschi di Siena, that's one thing. German banks, Deutsche Bank, it's kind of it's a massive bank, and very complex. It was a couple of years ago. It was chosen as the biggest kind of risk bank in terms of a systematic risk, because it's massive derivatives trading operations. So it's massive player in derivatives markets, and the derivatives market kind of you can easily win, you can easily lose. And if it was that in the first half a year last year was bad for Deutsche Bank's derivatives trading, so obviously that has led to losses. So Deutsche Bank has been make losses for several years in a row. So in terms of cost to income ratio, that's really bad. So that's why I suggested that when comparing different banks, so comparing Deutsche Bank and Aktia, comparing Deutsche Bank and Nordea is kind of questionable, because the operations are so different from each other. Aktia is a pretty, why I like it as a case company for a group for this course, is that it's kind of a understandable by structure. It's not big in derivatives or anything exotic. It's pretty plain vanilla in terms of the basic banking operations. It has been growing the asset management, pretty understandable as well. They also have life insurance business, so it's not only that they would be only banking or asset management, but they have banking, asset management, and insurance business. So that's why I like it. It's kind of easy to understand what they are doing. Nordea would be much bigger. Deutsche Bank would be kind of, if you read Deutsche Bank's annual report, it's hardly understandable what all different activities they are involved in. So it's so complex. So their cost to income ratio, of course, they are also trying to push that down, but they have been making losses so many years in a row, and the cost base is pretty fixed. So you can't kind of get rid of costs easily, as just in Aktia's case example. Just to save 3 million, it's kind of a lot of activities, a lot of branches need to be merged. So and IT costs are even more difficult kind of to save. It easily happens that the IT costs are just going up all the time. So those might be the reasons why definitely there might be other reasons as well, but why these ratios are so different. Because if just might think that, okay, banks are all trying to push the cost to income ratios down, but in last year, in some banks, they were going up. So they are going up, such as in Commerzbank, 107 relative to 70. The only way to explain this is that they have made losses. So that's the only way. The other ways you can't make this kind of a big increase. Credit Suisse also, banks have had, as we were discussing on Thursday, European banks have had a massive kind of a profitability challenge for many years now. Russian banks, why they are so efficient, please don't ask me. I have no clue kind of whether I trust them, the ratios. It's better that I say nothing kind of a, it could be that they are doing good business, at least efficiently, it looks so. Okay, then the first important ratio, capital adequacy ratio, is tier 1 capital plus tier 2 capital divided by something called risk-weighted assets. So this is where banks are different from other companies. Banking sector in Finland, 2009 till 2021, we can see that all these ratios have been going up. If you look at this common equity tier 1 ratio, let's, for the sake of simplicity, I said this once more, let's say that it's equity, shareholders' equity plus retained earnings divided by these risk-weighted assets. So it has increased from the level of something like 12 plus to the level of 18. So banks' balance sheets have become stronger in the recent say 5-6 years. Sorry. And then we come to the European comparison. Remember, this one we had on Thursday. European comparison, and there we could point out that in Estonia, the equity ratios are close to 30%. And I can't remember who it was, but you asked that, okay, why is Estonia kind of standing out? Luckily, this was Thursday. Luckily, on Friday, I had a kind of keynote speak at Estonian Economic Association annual meeting. And there, just before me, there was a representative of Estonia Central Bank. So I had the opportunity to ask him that, please kind of help me, as my students asked, that how can it be that kind of Estonian banks are so strong in terms of the equity ratios? And because I have no clue. The reason is kind of course, I should have understood this kind of way, but I didn't care to think about that, is he said that first, Estonian banks have been very profitable in the recent years. Okay, so far so good. Plus the big thing was that Estonian tax system, as in Estonia, like any other companies, banks also, they do not need to pay taxes if they don't pay dividends. So that is what we know, Estonian tax system. That is something that, of course, I know that, but I always thought about kind of industrial companies or any other company, but it also applies to banks. So banks have made profits and they have not paid dividends. So as a result of that, your equity ratios go up. Or actually, you should say that they will not go down, because when a bank pays dividend, like any company pays a dividend, so that will decrease the equity. But they have not been paid dividends, so they have avoided tax payments. So that explains why Estonian banks are so high on this. So I'm so happy that we happened to lecture just on Thursday, and you made kind of the question that explains. Overall, kind of most of the banks in Europe, as we were discussing, if the threshold is 15 plus, so most of the banks are above. The Greece, Spanish, Portuguese, Austrian banks are a bit below. Actias, as was mentioned, the common equity one ratio was 2.7% lower. It has come down over the years a bit, as Actia has been paying dividends. So it's central common equity tier 1 capital has to be decreasing by 115 million. There was some kind of accounting kind of related kind of issue, plus the dividend payment, which has been deducted from the equity ratio. So in that sense, banks are like any other companies. When you pay a dividend, the equity kind of the amount of equity goes down. They had issued something called AT1 capital of 60 million, so that is included in tier 1 capital ratio. It's kind of a pretty detailed area, so for the sake of simplicity, let's just talk about equity ratios here. How these risk-weighted assets are calculated, that is the key. This is from Actia's interim report. They explain how the common equity tier 1 capital is calculated. There are many regulatory adjustments. 308 million plus 60 million you get to total tier 1 capital. See, 368. So that is their equity tier 1 capital. Plus tier 2 capital is 72. You get total own funds 440. That is divided by something called risk-weighted assets. of some of our credit risk, in which they use standardized model, and for some credit risk they use something called IRB model, and some have something called 15% risk floor for residential mortgages. So it sounds a pretty complicated, but the more you kind of take a closer look, so it's not that complicated. But it's start that different assets have different weights. Because the Basel Committee on Bank Supervision was founded in 1974, so they issued, you could say, the rules called accords, how these ratios should be, how they should be calculated in banking world. The first Basel Accord came in 1988. There was a Tier 1 capital requirement of 4%. In 2008 came these IRBA models and risk weights on dependent on credit ratings. And then further, after banking crisis, came some increases in these requirements, plus something called minimum leverage ratio. This I will explain to you. Then they became liquidity coverage ratio, net stable funding ratio, and some additional equity buffers. We are not going into details of these. It's kind of pretty, because we don't want to go too much into details, just to see that there's new regulation, new ratios that are being required as a result of the financial crisis. That is enough. Okay. The Basel I said that the risk assets ratio should be at least 8. So capital Tier 1 plus capital tier 2 divided by risk-weighted assets should be at least 8. How are these asset weights kind of risk weighted? So that is the most important thing. So example of weights. So gold, cash gold, bonds issued by OECD governments, bank does not need any equity because those are considered to be risk-free. So regulatory authority says, okay, you don't need to have any equity because these are risk-free. The risk that we will lose money here is 0. Receivables from banks, you weight them by multiplying these kind of receivables by multiplying them by 0.2. Mortgages, you multiply by 0.5. All corporate loans are at their nominal value. Okay, so not all assets are similar. They have nominal values, but in this risk calculation, so different assets have different risks, so that leads to different weights that they are given in calculating how much equity is required from a bank. How can a bank increase their capital ratio? Of course, first you can increase, you can have a rights issue. Banks, like any other companies, can raise new capital, or you can, after making a profit, you decide that you are not paying dividends. So you as in terms of retained profits, your equity ratio goes up. Or you could keep the same amount of equity capital, but you could reduce the risk-weighted assets. So instead of lending for corporates, you lend to governments, such as you borrow government bonds. So you keep the money in cash. So those assets consume much less equity. Deutsche Bank, in a very nice article in 2017, they summarized where European banks do stand. They concluded that risk-weighted assets are more than 20% lower than a decade ago, so that it was the financial crisis hit. So they concluded, and this is kind of a macro level question, but the question is that when this regulatory, which is kind of, one could say that it's understandable, the financial crisis hit and taxpayers were forced to bail out banks, also in Europe. Spanish banks, this 100 billion, sorry, kind of as one example. So there's no other way than find the taxpayer money to bail out the banks. And this was with good reason, kind of taxpayers said, okay, we do not want to do this anymore. So next time, make sure that banks have more skin in the game. So banks' equity ratios must be much stronger. So the regulatory requirements have been tightening all these years. So it's kind of understandable, but that has not come without any cost, because banks have been forced to increase their equity ratios, risk-weighted, so they have been less willing to make this risky lending. So customers have not been able to borrow money, especially for risky kind of projects. So clients had to look for alternative sources of financing. So that has been the end product. Okay, it was not the intention, but banks have been solved this issue as raising new equity is pretty challenging. It's a tough job. So they have solved this by decreasing lending to risky customers because the capital requirements are so tough. Has also led to the capital markets increasing, which is kind of in the capital markets union, which is kind of what is being hoped, that European bond market would be kind of grow. Shadow banking has been growing as well. We'll talk about shadow banking as a separate topic. And some customers just ended up being credit constrained. So some customers have not been able to borrow money the same way as they were able to borrow money before this financial crisis. This is the consequence of this tightening bank regulation has had on the main street. So that is the real economy. So that is what has happened. Then came Basel II, Basel III. Instead of giving these fixed weights, such as corporate borrowings or governments, the Basel II said, okay, let's use the credit rating rather than just a simple percentage. And you might say, of course, this makes sense, because it used to be in the first round, all corporate debt was given 100% paid. Of course, there's a difference whether you lend money for, say, Fortum, or if you lend money to some startup company or whatever, Vesa's hedge fund company. So, of course, there's a big difference in credit risk. So banks were led to use the credit rating rather than a simple percentage. As follows: the cash still has a weight of 0. Residential mortgage 35, and then government securities, interbank loans, corporate loans by rating. So this was a big change for you would say for better. Then the regulation was developed further. Was that big banks, and this was for the big banks only had kind of the opportunity, were allowed to use their own risk models, but these had to be approved by the supervisor. And these are called IRB models, so internal rating-based models. So banks which have developed risk management techniques, and if they can convince the regulator, the supervisor, that we are very good in evaluating the true risks of our customers, so banks were led to use their own risk metrics, these internal rating-based models, instead of the standardized model. What the regulator says that, okay, one size fits all, banks were led to use their own models. And Actia 2015, this is from their annual report, they proudly said that we have received a permission to apply internal risk classification to the calculation of capital required for retail exposures. So as a result, 58% of the bank group's exposures are calculated according to the IRB approach, So that is 58. The remaining is applied. For the remaining part, standardized approach is used. The average risk weight for retail exposures with real estate collateral calculated according to the IRB approach was 15% compared to the 35% using the standardized model. So the lower risk weight resulted in improvement of Aktia's common equity tier 1 capital ratio compared with the previous year. So in a sense, so you could say that, okay, nothing else changed, but instead of using this 35%, so Aktia got the permission to use 15%. So that resulted in a kind of less risk from the regulator's point of view. So that increased Aktia's tier 1 capital ratio clearly. So clearly risk weight resulted in improvement. So Aktia's balance sheet as a result of this looked much stronger, even though the balance sheet was the same. But by this, according to this ratio, it was much stronger. Surprise, surprise, there was an Economist article in 2013 already with the title, How Good Are These IRBA Models, these internal rating-based assessments. So as a result, they estimated, they looked at Deutsche Bank, KBC, BNB, and so on. Estimated impact on core capital by asset class moving from bank's own model to standardized model. So surprise, surprise, as big banks got the permission to use their internal models, for all banks, the risks became lower, meaning that the equity ratios strengthened. So this was in the interest of all the banks. By now, the balance sheets were the same, but the balance sheets looked after this change stronger. And that is something that Aktia, as an example, was proud in saying that now our financial metrics kind of look better. Sorry. Now there was an article in Financial Times raising concerns that banks in Europe and elsewhere are moving to meet new, tougher capital requirements by tinkering with the internal models to make their holdings appear less risky. Now, the question was that are banks playing with the numbers now? Something is called risk-weighted asset optimization. So banks are kind of using their own risk metrics, these credit internal rating models, which make the assets to look too kind of, the risk is too low relative to what the risk really is. Well, let's jump to this in a minute. As one additional metrics that was kind of launched in Basel III was something called leverage ratio. And this is something that this has nothing to do with the risk weights. That's kind of an old school, very simple metrics. This is calculated by dividing tier 1 capital by the bank's total average consolidated assets. There is no risk weights, just kind of a non-risk-based backstop measure. Minimum is 3%. So at least banks needs to have equity worth of 3% of the balance sheet. Let me jump back to where we started. Here, this is something that page 7, Mikko referred to Aktia's equity being 755 million relative to 11 billion, that's only 6.6%. So this is the gearing ratio of Aktia Group. So it's like what would be a good kind of equity ratio in banking terminology, kind of a gearing leverage ratio. So typically, if you look at industrial companies, they have 50% equity ratio, 40, 45, 60. In the banking world, you see this company, and Aktia is considered to be pretty good, pretty well capitalized of a bank. But this is on the group level, only 6.6%. In Aktia banks, example, this is from Aktia's interview report. Aktia bank groups leverage ratio. So this is not the whole kind of Aktia, but Aktia banks group leverage ratio was 3.7%. So tier 1 capital divided by total exposure is 3.7. So and the minimum is 3. And Aktia Bank and all its subsidiaries except Aktia Life Insurance is excluded from this. So Aktia seems to satisfy this minimum of 3%. Other new minimums, this is just kind of to show that as banks have been complaining about this regulation tsunami, they have a point. So much new regulation has come after the financial crisis. Just if you look at the BIS report 2010, Basel III regulatory, global regulatory framework for more resilient banks and banking system, it's 77 pages, and it's pretty complicated, I can tell you. As I said, things can get a bit complicated. There were new kind of requirements kind of that were launched, especially for the big banks, such as Nordea and Deutsche Bank. Capital conservation buffer, countercyclical capital buffer, other systemically important institutions kind of a buffer. And just to make clear, we are not going into details of this course, just to highlight that many new kind of requirements and many new kind of metrics have been launched since global financial crisis 2018. And this is something that especially big banks are facing, kind of they're tackling this every day. Then the last question is that why bank balance sheets and performance and risk are so hard to evaluate. Remember the asset quality review we learned that was launched in 2014 before the European Central Bank took the responsibility to supervise the biggest bank. We needed a more greater transparency. There were kind of big misstatements in the previous, even though they were accepted by the management, by the board, by the auditor, by the local regulator, but still, especially non-performing loans, kind of where could say the risks were not highlighted well enough. So why is this? So there is nobody knows exactly. Bank only knows to whom they have lent the money. So who are these borrowers? And banks obviously have an incentive to hide these risks. So if the bank recognizes they have lent money to some client, it turns out to be more risky than what bank originally thought. Okay, that's bad news. But banks obviously have an incentive to hide that and to lower the riskiness as the risk is being measured when these equity ratios are calculated. So instead of the nominal terms, the riskiness is included in these calculations. So that might lead to kind of a questioning the relevance, the truthfulness of these IRBA models. And that has led to something called Basel IV, and this is where we started from. It has been there in planning for some time already. So remember, to put this in perspective, what happened was that world faced financial crisis. Basel I was in making and in use already. It has developed, and the idea is that first to allow banks to calculate the risks as realistically as possible, even using their own IRBA models, to give as truthful a picture about the risking of the assets. And the equity is then divided by these risk-weighted assets. Now the question is that has this gone too far? As Basel Committee highlighted a worrying degree of variability in banks' calculation of their own risk-weighted assets. So under the Basel IV, banks can no longer use these typically more sophisticated and complicated internal risk models for large corporates with a turnover of at least 500 million. So they are planning to introduce something called an output floor. And you could say that this is Nordea's statement. At maximum, you can reduce your risk-weighted assets by 27%. So this is a major change that affects how much benefit you can get from these internal models. So it affects the banks that are using internal models the most. Nordea is one of them. So essentially, the regulatory authorities are saying that, in a way, we gave you too much leeway in kind of to define the risks. So we are tightening this further. So we are no longer allowing you to use these internal models. So this is kind of I see banks kind of being at least irritated that first you give us this option, but then now you take it away. This will take effect, at least currently the forecast that it will take effect in 2023. Whether it will really take place and how banks are playing this remains to be seen. But as we can see, a lot has changed in the banking regulation in the last say 14 years or so, 14, 15 years ago or so. Okay, if you go to the very beginning, kind of I propose that today we would be able to answer your questions. How are banks' capital ratios calculated? So some ratios are calculated as for any companies, but banks are different animals as the risks of the assets is being kind of considered by the regulator. So equity is divided by the risk-weighted assets instead of just the nominal value of assets. So that leads, as we can see in this Aktia's case. Sorry. Here, these are nominal values. So equity 6.6% of the nominal value of the total balance. But if you calculate from the risk-weighted assets, you get a much higher number, something above 10%. So that's why banks are different. What is a Basel regulation? So Basel is they have been launching their own accords. They do not have they can't directly kind of influence the regulation. So the regulation then is adopted locally in each country, kind of according to the Basel kind of suggestions, proposals. In the time schedule that countries have adopted. So some of these are adopted kind of gradually. So it doesn't happen overnight in all of everywhere in the world. Why banks' balance sheets, performance and risk are so hard to evaluate? The essence is that nobody can see the riskiness of the loan portfolios as a third party, as an external observer. So you must rely on banks' kind of information that banks provide. And banks have an incentive to obviously banks have an incentive to kind of show less risky holdings than could be the truth, the reality. So that is an inherent challenge in evaluating the performance of banks' balance sheets. Okay, any questions, comments you might have on banks' performance evaluation, strength, regulation? Anything, please? Any comments? How does this sound? is one of the key kind of issues in banking, how the equity ratios are calculated. They are different than in any other. Why banks are forced to use IRBA on all holdings instead of getting to use it on just less than standard risky holdings? Why event? They were not forced to use. This is something that banks needed to. For Aktia, it took for many years. So they were trying to convince the financial supervision that the risk models are sophisticated. But financial supervision first gave the permission to big banks. So Nordea was there, OP was there, and then Aktia was next in line. And Aktia applied for the permission to evaluate certain portfolios, not all of them, but they were able to decide which portfolios they would like to apply this IRBA, and they left themselves. Others were kind of they continued the standardized model. So why weren't banks forced to use IRBA on all holdings? So it is kind of not that the regulator forced anybody to use IRBA models, but the banks wanted to use their own models because the end result was that they were able to show a smaller risk in the lending portfolio than what the standardized model would suggest. Does this answer your question, or is there something that getting to use it on just this kind of the setting was that banks applied the license to utilize their own models instead of the one that the regulator provided. Any other questions? This is something that we'll talk about the regulation as a next year, Thursday, we'll talk about the central bank's activities, and we'll have a separate kind of session for regulation. And it's obvious that banks have been complaining all these years that this tightening, the regulation tsunami, as they are calling it, so it's too tight. And one dimension, they have a point in that as the banks are regulating tougher and tougher, the regulation becomes tougher and tougher. So it makes banking less attractive as an investment target. So equity holders find it less attractive to invest in banking business because there's a profitability issues out there, and now more equity is being required. So the return on equity is lower, assuming that the profits are the same. So the more equity is being required, so the return on equity is lower. So it's not an attractive sector to invest. So banks have challenged to kind of to raise new equity. So banks have a point there, and obviously kind of banks have a point that kind of this opens the door for shadow banking. So for players who are not banks, who are not supervised by the banks, so there's it's easier for them to grow in the markets because there's less regulation. But they ended up using IRBA on only the corporate bonds that should be weighted less than 100%, and using the standard method on those that should have weight of over 100%. Is this correct? Let me kind of think about this. They ended up using this for any bond portfolio that they liked. Mostly, this was applied in mortgage bonds, mortgage loans, so housing loan portfolios. So that's where banks were using this opportunity to utilize IRBA models, as essentially in Nordic banks. Housing loans historically have been kind of risk-free, so credit losses there have been minimal. Corporate bonds, that should have a weight of over 100%. Is this correct? So it never must be over 100%. So 100% is the maximum, but you can have less than 100% weight if you can show that the riskiness is low. So that is kind of a if banks are able to convince the regulator that according to their sophisticated models, they can show that the risks are less than what the standardized models say. So it was considered that as an option that the banks were not forced to use. But no longer that it shows that this option will be taken away as a result of this Basel IV. Okay, very interesting kind of a development, very interesting kind of a new numbers. If you are interested in this, so I encourage you to take a look at kind of where do we go? I would say as a joke, if you don't get sleep in the evening, I encourage you please take a look at the BIS report for Basel III regulation. It's pretty kind of sleepy material, kind of a lot of complicated things. This is something that banks who are the directors of bank, the risk management, this is something that they are experts. We do not need to become the experts on this, but what we need to be understand is that how banks equity ratios are being calculated different from other companies, and how this regulation has evolved, why that has developed, and what Basel, now as there will be articles in Financial Times that Basel IV is coming, and banks are complaining that this is too much for us to bear, so we know what the topic is about. Are we done? Good. On Thursday then, I'll be back in Finland. Okay. It's kind of irrelevant where I am. I don't know where you are. It's pretty weird world. I'll come back to Finland tomorrow. I will maybe tomorrow morning, tomorrow evening, I will download the central bank kind of slides, and I will put the Zoom link also kind of on my courses page. So kind of let's continue on central banks then on Thursday. If no other questions are raised. Okay. Cheers. See you on Thursday then. Cheers.